Hey guys, this is Scott Horne with Horne of Associates PC. I want to take a minute and just talk about this great topic we call escrow impounds. People go, what the heck's an escrow impound? I'll tell you in a moment. Anyway, if you like the video, guys, take a minute and like it, please. Don't forget to comment below. We'll get back to you on those. Come over and join us on our YouTube channel as well. So, escrow impounds, what are they? And we're going to talk traditional escrow. We're going to talk about seller financing and things of that nature a little bit, but a escrow impound is simply your extra monies being paid into your escrow account. Whenever you buy a property, you get a mortgage where that mortgage is requiring escrow to be collected, and escrow in this case would be taxes and insurance. They're going to collect the monthly percentages of whatever 1/12 of the taxes are and 1/12 of your insurance policy is as well, so that when those come due, they're holding sufficient money in their account to ensure that they can pay your taxes timely and that they can pay your insurance on its anniversary date. Now, if you buy a property, let's say on July the 1st, 6 months into the year, your seller is going to issue to you 6 months of taxes at closing. And likewise, that 6 months is going to be paid to your lender, who's going to hold those and then collect taxes going forward. Now keep in mind, if you buy a house on July 1, your first payment is going to be August 1. So at the closing table, your lender is at bare minimum going to want you to pay the July taxes at closing. That way your account is fully funded for the year for your property taxes. As you go forward, August, September, October, you pay 1/12 of those taxes as well. Now, in today's world, lenders want a little bit more than that though, and we'll get there in a minute. So let's talk a minute about insurance in the same fashion. You close on the same date, July the 1st, and your insurance is paid 1 year in advance. So now your mortgage company holds that insurance that you've already paid for a year. Now, in addition, you're going to start paying insurance just like you do with taxes going forward. Your first payment is August the 1st, meaning you didn't make a July payment, so they're going to want to collect at least 1 month of insurance at the closing table, and you're going to pay insurance going forward for the next 12 months. So with property taxes, you didn't pay anything up front. You pay each month going forward. If insurance, you pay a year up front, and then you pay a month going forward. Why? Well, with property taxes, this is kind of like a rental payment, versus a mortgage payment. In a rental payment, you pay rent on the 1st for the right to live in the house for the next 30 days. With a mortgage payment, you buy the property, you incur interest for the first 30 days or so, and then you pay the interest backwards. Well, it's the same thing with taxes and insurance. You pay taxes backwards at the end of the year as they come due, but with insurance, you pay it forward. And the reason you pay insurance forward is the last thing you want to do is to have your insurance policy lapse and have a catastrophe hit your house, tornado, fire, whatever it might be, and then turn around and not have coverage. And that's why those two are handled a little bit differently. Now, going back to our example of this July 1 closing, lenders can collect, in addition to that July tax and insurance payment to fund your account, additional insurance, typically of about 2 months each, 2 months of taxes and 2 months insurance. So why do they do that? Well, they do this just so that their account is fully funded, so in the event there are changes along the way, or maybe you've missed a payment along the way, the escrow account is still funded so they can pay taxes and or insurance reasonably timely as those come due. So it's important to think along the way on how those kind of things work. Now, when you come to do a closing, you may get hit with a mortgage insurance premium. It can be called MIP or it could be called PMI, either way, just based upon whether it's an FHA type loan or a traditional, conventional type lending. In today's world, if you're paying mortgage insurance, just like taxes, you're paying that mortgage insurance every month into the account so that each year your lender can pay that mortgage insurance premium for you. Now, if you're getting an FHA loan or a government insured loan of that nature, and there is mortgage insurance associated with your loan, you're paying it for the life of the loan. It used to be that when you got to an 80% of the appraised value, so your loan was paid down sufficiently, that in the marketplace it was 80% of the appraised value, you could petition the mortgage company to drop the mortgage insurance, and they would do so. After the 2008-9 real estate crash, no more. They lost so many billions or trillions of dollars, whatever it was they lost, that they're now collecting that money for the life of the loan with a government insured type loan. Now, if your lender is conventional and they're requiring mortgage insurance, once you get to that 80% of the value, you can request that lender to reduce and to do away with the mortgage insurance premium, and they will do so for you. Typically what mortgage insurance does, guys, is it insures the top 20% of the loan. So in other words, if there is a default in the mortgage, the insurance company pays the mortgage company 20% of the loan balance, and then the lender, of course, takes the loss on the balance out. There's how that works. Now, you have sometimes some options whether you want to have an escrow account and have impounds out there or not have an escrow account. Typically, it is required in most cases unless you're hitting a situation where conventionally you're making at least a 20% down payment. This is a situation where you demonstrate you have the ability to make larger down payments. You provide the lender less risk of taxes or insurance not being paid along the way. And in that case, you can pay a small fee to waive escrow. So this is where I come out and say, no, you have the choice of learning how to either be smart or to be stupid. Now, if you can manage your money well, you can manage your taxes and insurance, so you know when this comes due, you know you have the ability to pay it regardless of what's going on, maybe it's smart not to have an escrow account. Personally, I don't have one. I'd rather invest my money somewhere else along the way than to let the mortgage company just hold it sitting there for the life of my loan. On the flip side, if you're not a good money manager and you have issues and problems, it may not be very wise not to have an escrow account. One of the things that Dodd-Frank came up with when it went into effect back in 2012 is requiring most mortgage lenders to require an escrow account. The days of 80-20 type lending is over. That's basically 100% financing in those scenarios. And you might be able to avoid paying taxes and insurance. Well, people, for the most part, weren't very good savers and didn't have the ability to pay the taxes and insurance, forcing the lenders to pay that and costing way too much money. They did away with that. In the creative finance world, we're under the Dodd-Frank rules and regulations also, and we collect escrow on every single deal we do, no matter what. From a lender's perspective, it's just a smart thing to do also. It's just as a preventative mechanism. So unless you've got a really good borrower who put a lot of skin in the game so that everybody's protected and there's a certain knowledge base that that person can make those payments, always collect escrow. If you're the borrower trying to make that decision what to do, again, if you have the option to waive escrow, that comes down to a personal decision and one of your ability to make those payments as they happen. And maybe you just go, hey guys, let's just pay the escrow, not worry about it, put it out of sight, out of mind. It's just part of my monthly payment. And so come year end, I don't need to worry about coming up with that $8, $10, $20, $50,000 a year payment out there based upon the value of your home and your tax liability. Guys, here in Texas, our taxes are really high for property. Other states, they may be a third of what ours are. That gives you that mental perspective of being able to make an easier decision whether to escrow or not escrow in those situations, because those dollar amounts can be so much less in other states. But again, be smart in how you do those kind of things out there. Understand how escrow impounds work, how taxes and insurance work going forward and backwards, why it looks like in the course of the first year you actually pay for insurance twice, and that's okay, it's for your protection, and how all this stuff marries together. And you understand how lenders and mortgage companies work along the way when they're setting up escrow impounds. So guys, I hope you found this video helpful. If you did, take a minute and like it, please. make any comments below. We'll get to those for you as well. Come see us on our YouTube channel, and we'll see you guys next time.